Easter Monday finds most of Europe still closed, but that didn't stop gold from moving slightly higher. We'll be talking about some fresh fundamentals with Peter Hug next. Peter, happy Easter Monday to you.
Happy Easter, Daniela.
Peter, let's talk about that money flowing into U.S. equities. I know you suggested this means people are seeing that there's less risk on the global front, and you strongly feel otherwise. Let's start off with this today.
Yeah, I don't think there's been a lot of fundamental change in the overall risk profile from a global perspective. I think over the past month, there has been movement into the equity markets in the United States. And as a result, a lot of ETF outflows of precious metals. Clients that have profits in the ETFs have been taking their profits and allocating some of that money into the U.S. equity markets. My personal feeling is I think the U.S. equity markets are way ahead of themselves. And albeit we've had a 10% gain in the first quarter, I think the gains going forward will be muted. And then focus again will be on the European situation with some of the financial issues that are arising. As early as this morning, there's talk on a run on the third largest Italian bank. The Cyprus issue is still fresh in everyone's mind. I think European issues will continue to dominate the news over the next 2 or 3 months.
Peter, let's talk about why you think there might be a belief in a recovery of the U.S. economy. What do you think is fueling it? Is it the stronger U.S. dollar we're seeing? Is it better jobs data? What do you think is behind it?
I think it's a matter of putting your money in a place that's the least worst place to put your money. I don't think it's anything more than that. I don't think the U.S. recovery is as solid as the stock market indicates. I think the stock market is there because of free money. Historically, the metals over the past 4 or 5 years have been moving with the stock market as a risk asset. They broke that relationship about 2 months ago. I don't think that's warranted. I'm not suggesting that we're going to see gold at $2,000 an ounce unless there's a major euro issue coming up in the short term. But I think the bailing out on the metal side is premature.
Right. And the ISM survey out this morning, Peter, showed that the manufacturing sector expansion has slowed a bit. But right now, let's look at some key figures you're looking at for gold and silver, some key support and resistance levels.
Yeah, gold was in the, when I suggested gold was in a tight range of 1588 to 1610, and it's still in that range as we speak this morning. What bothered me was the action on silver with gold approaching 1600. I thought silver should have maintained itself over 29, and I was very cautious and suggested that silver was vulnerable to the downside with initial support at 28.20, and if it got through 28.20, the next level down is going to be solely, in my opinion, based on gold. So I'm still, as I put out in the blog this morning, of the belief that I would, as a trader, not enter this gold market until this range is broken. But I caution that if 1588 is broken on gold, silver testing last year's low of 26.27 is still on my horizon.
Peter, when you say wait for the range to be broken, do you intend either side of that range?
That's correct, on either side. I wouldn't go long this market until I got a clear, solid close over 1610, not an intraday trade, and a clear close below 1588 would encourage me to short the market.
Peter, before we move over to PGMs, let's look at China's March PMI, which rose to an 11-month high of 50.9, indicating growth in the second largest economy in the world. Might this hurt gold?
Again, these markets are perception. Those were, they were March numbers. Yes, they were the best numbers in 11 months. If the trend continues in China, I would suspect that the Chinese will start to tighten their monetary policy. But again, this is one number. However, if the Chinese do believe that their economy is now on solid footing, I would expect their easing policy to relinquish a bit and a tightening to follow, which could be negative for the metals.
Peter, I'd like to get your thoughts now on a news item that came out last week regarding the PGMs. A Russian official indicating that he would like to see an OPEC-style agreement with South Africa for the PGMs. What might this mean for the platinum group metals landscape?
Well, I would think it's very bullish. Again, having been in this market for the past 40-odd years, the Russians, specifically in the 80s and 90s, were notorious for not honoring contracts and withholding supplies to the market until they got their price. An OPEC type of an arrangement with South Africa, where there would be a combined control over supply to the market, would, in my opinion, be price positive for the metals. And if this were to come to pass, notwithstanding the issues South Africa has on its own with its electricity and power issues and its strike issues, put this control of supply into the Russian hands. To me, that's a very, very bullish trigger, and I would definitely be looking to go along the PGMs.
Peter, thanks for your thoughts this Monday. We'll see you next week.
Okay, see you then.
And thanks for watching this edition of For Pete's Sake. You can email us, as always, at newsfeedback@kitco.com or tweet me at Daniela Cambone. Thanks for watching.